value at risk. We talked a little bit about VAR, or value at risk, in the credit risk chapter. And we said, if you remember, VAR is used to predict potential exposure, potential credit risk exposure. For example, what is our future credit risk exposure? And if you remember, I told you that VAR is used for both credit risk and market risk. This, by the way, comes in the exam. Which of the following risks can you use VAR for? You can use VAR for credit and market risk. So what is VAR? VAR, just a little bit of history. VAR started in the 90s, in the late 80s, in the early 90s. They were the CEO of JP Morgan. His name was Dennis Weatherstone. He used to receive daily reports on the risks that JP Morgan were facing. Of course, these reports were very big because JP Morgan is a global bank, probably the biggest bank in America. So he got tired of these big reports, and he asked his risk team to come back and give him one page. He wants a single page, one report, one page that gives him an idea about how much risk he has in the market. Of course, that report is famous too. It's called the 4:15 p.m. report because he receives it 15 minutes after the markets are closed. It's just a single page that gives him an idea about how much risk he currently has in the market. So what's in that one-page report? In that one-page report, the team gives him three very basic information. One, the team will say our maximum loss today or this week or this month, let's say our maximum loss in this month is going to be $50 million. So it gives you an amount, maximum loss. It gives you the period, the month, and it gives you one more thing, and that is the confidence. I mean, if you go to your CEO and you tell your CEO, I believe that our maximum loss in the month of March is going to be $50 million. I mean, obviously, the next question it's going to ask you is, how confident are you? Are you sure? How sure are you? Confidence. And let's say we have a 99% confidence, or a 95% confidence, or a 90% confidence, whatever that is. And that's VAR. That is the value at risk. The value at risk is $50 million. Currently, our risk is $50 million. What's the duration of that risk? There's a chance that we are going to lose that money in 1 month. How confident are we? We are 99% confident. So VAR is made up of three numbers: value at risk, the period, and the confidence. That's it. This can be used for investments. This can be used for credit. Now, if you are asked in the exam, what are the advantages of VAR? It's very easy. It's based on data. This can be both an advantage and disadvantage. So if you have good data, then VAR will be excellent. If you don't have good historical data, then you cannot use VAR. Also, VAR is easy to understand. You don't need to be in finance or a financial professional to know what $50 million loss in 1 month means. It's very simple. Now, the limitations of VAR, you might be questioning this. Now, VAR says we stand to lose $50 million in 1 month. How confident are we? We are 99% confident. What VAR doesn't tell you is what happens in the 1% case. So we are 99% confident that our losses will not be more than 50 million. So we are 1% confident that our losses will be above 50 million. How much above 50 million? 60 million? 100 million? 1 billion? It doesn't give you. VAR does not tell you how bad it gets. And that's why, in addition to that question, what's the disadvantage of VAR? Basically, it doesn't tell us how bad it gets. The next question usually is, well, what's the solution to that problem? If VAR doesn't tell you how bad it gets, then the solution is you combine it with stress testing. Everything we've discussed, all of these will come in the exam. VAR is a critical element of any risk qualification, whether it's from CISI or any other provider. VAR is always involved in every exam. So what is VAR? The advantages of VAR, the disadvantages of VAR, and disadvantages of VAR, for example, it doesn't specify how bad it gets. Well, what do we do? We usually combine it with stress testing. Of course, VAR is considered to be a model, a financial model. How do we calculate VAR? How do you calculate the value at risk? Well, there is one way. You can say, for example, if the CEO asks you, how did you arrive at this $50 million in 1 month? Our maximum loss will not be more than $50 million in 1 month. Well, you can say, we are currently in March. I looked at our losses every March for the last 50 years. And for the last 50 years, our losses in March were never more than 50 million. That means you have used historical data. VAR can be calculated from historical data. Historical data is the least controversial. So there are 3 methods for you to calculate the VAR. You either use the historical data, which I just gave you. It is not controversial, but it assumes that history repeats itself. So just because for the last 50 years your losses never crossed 50 million, it doesn't mean that this year it will never cross 50 million. Looking at the current market situations with the coronavirus, there is a chance you might lose more than 50 million. That's historical simulation. The second way is through the use of statistics. Statistics, standard deviation, 95% confidence, 99% confidence, standard deviation, normal distribution curves, skewed curves, stuff like that. This is also called parametric. So in the exam, you might either see the word statistics or parametric. Or you can use the Monte Carlo simulation. I'm sorry. We can use the Monte Carlo simulation. Which was invented, I think, in the 70s or a few years back by a mathematician who went to Monte Carlo to gamble, but he got sick and he stayed in the hotel. And while he was in the hotel, he invented the mathematical formula. Monte Carlo, in this exam, if you are asked about what is Monte Carlo generates random scenarios. And from these random scenarios, you can create or you can predict a value at risk. Random numbers, random scenarios, usually take the average, and from these random scenarios, you predict your value at risk. So in the exam, if CISI asks you which of the following methods uses mathematical formulas and random scenarios, that's Monte Carlo. You don't need to go into any more detail on these. If you are interested in how Monte Carlo works, on our e-learning portal and mobile app Tadawul exams, there is an Excel file just look through the portal and you will find it's called the Monte Carlo simulation. Download it and play around with the numbers and see how through Excel we can create different scenarios and we can predict where our portfolio is going to be in 10 years. Those of you who don't have access to our e-learning portal, it's free of charge. To anyone who's interested, just drop me a message by WhatsApp. My number is at the beginning of the video, and I'll give you a free username and password. Good luck, and I will see you in chapter 6.